Hi everyone. So something I'm really passionate about is the stock market, and not just stock market as in day-to-day trading of financial assets, Apple stock or Google stock, whatever. But what I'm curious about is the long term of the stock market. What causes the stock market to go up in the long term? So there's something interesting called the equity premium puzzle, which essentially is the long time puzzle which economists have been trying to solve for decades. Which essentially goes as why the U.S. stock market has been able to outperform U.S. government bonds by roughly about 6% a year, um, or about a 6% difference between the returns of U.S. government bonds or U.S. Treasury bills, effectively, versus the U.S. stock market itself. And so, my hypothesis is essentially it's simply people demanding higher and higher prices over time in the long term. So even though in the short term you might have, something called a share turnover ratio, which basically means that you compare the ratio between the you're trying to show like how frequently stocks are being traded relative to the amount of stocks that are available to be traded. So that's one thing that could obviously affect a price. So if only 10 people are trading back and forth a stock, say like a big stock like Apple or so on a given moment of time, then and if a lot of people are demanding it at a much higher price, then effectively it's going to probably cause a huge price jump relative to the amount of money that's actually put into it, as opposed to if there's a lot of noise, if there's a lot of high volume, if a lot of people are trading stocks back and forth, then even if there's a big amount of demand, there's not a huge amount of demand relative to there's not a huge change in sort of the whole market cap of the whole stock or so relative to the amount of money put into it or so. So what I think is important to look at what actually is causing people to demand higher and higher prices over time in the stock market is people effectively you take something like gross domestic savings or gross private savings. So you take all the whole GDP, consumption, investment, government spending, things like that, and then you subtract off final consumption. So you subtract off the money being spent in the economy, and you kind of have what's basically left over, and then that money is going to be used to either go into maybe like savings or bonds or actually go into the stock market, and a lot of it probably is going into the stock market to demand higher and higher prices over time. So even in the short term, you might have fluctuations between the money going into, maybe from stocks to bonds or from bonds to stocks. You might have short term fluctuations, meaning that you may not have a perfect correlation between gross domestic savings and the whole stock market. There is a very high, strong correlation, in fact, between, in my paper I written called a hypothesis for the equity premium puzzle and the success of the U.S. stock market. I think that's what it's called. I provide a link to it below this video description. But anyway, basically what I show is that there's a R value of roughly 0.97, so almost one, almost a perfect correlation between gross domestic savings and market cap, or market cap is like all the stocks, the value of all the stocks in the economy. So basically, you look at and you look at that and you have really high correlation. Also, same with other countries too. You have really high correlations. And not only that, but you also look at the Granger causality test, which basically shows, almost like a case for causation between two variables that might go up over. I think it's called like a time series or so, where basically two variables might go up over time. You're trying to show causation, and that shows a much better case for causation between gross domestic savings causing the increase in market cap and not the other way around. So it's really interesting. So anyway, please check out my paper, a hypothesis for the equity premium puzzle and success of the U.S. stock market. It can be found on my blog, Econ Team blog, so ECONTEEN blog, or on my academia.edu page, or again on the link provided in the video description. So it shall be taken with a grain of salt. It's just my hypothesis. But anyway, it's interesting stuff. So thank you so much, and please feel free to share with others. Thank you.